Alphabet just announced that they're going to be slowing hiring for the rest of the year. So you can add Alphabet to the list of other technology companies that we have covered on this channel or that you are aware on your own that have decided to either slow down or cut hiring in this environment. And so the question is, what does this mean for Alphabet's valuation and how should we be looking at this stock going forward? That's what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in the chat. You're watching More Money, let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. And this one's an interesting one and it wasn't unexpected. Alphabet recently did announce that they're going to be slowing down hiring, but that doesn't mean that they already haven't done a lot of hiring as it is this year. I think what it really comes down to is they're going to be focusing on hiring key roles as opposed to just growing the company outright by hiring as many roles as the hiring managers sort of needed, but could absolutely live without. The Wall Street Journal reported that Google is expected to slow hiring for the rest of the year. They just put Google, but it's really Alphabet. So their CEO, Sundar Pichai, urges employees to be more entrepreneurial in the memo. And from my perspective, I think what that really means is just operate leaner, which is kind of what you should be doing from the beginning, but there are departments that generally don't always operate or run their business units at the leanest levels, and that kind of makes sense for certain business units, but not all. In the email that he sent to employees, he said that Google will be slowing the pace for hiring for the rest of the year. But note that overall, Alphabet does have 17% more employees than it did from a year previously. So it's not like they weren't hiring in 2022. It's just now they kind of have to slow down. And so what he said was that moving forward, we need to be more entrepreneurial, working with a greater urgency, sharper focus, and more hunger than we've shown in sunnier days. So I think the days of tech companies running lean, people wearing multiple hats, those days are coming back as we've seen with many companies announcing layoffs. But that could be an opportunity for people that remain with these companies, because if you get the opportunity to wear multiple hats, well, you get the opportunity to develop a larger skill set. So I think this is an entrepreneurial opportunity for people that remain with these tech companies. But of course, this announcement is largely in line with what we're seeing with the rest of the technology industry. Ultra rapid hiring during the pandemic is now showing signs of cooling off, and there's a number of technology executives that are preparing for this to get worse. You guys know that Twitter, Netflix, and Amazon have already announced slowdowns in hiring or even cuts. You can see that Microsoft said that it's going to be cutting a small percentage of its staff. So that's even more than just freezing roles, right? And with Facebook, they actually got even more aggressive where they're telling managers to identify and push out low performing employees. And it doesn't say it in this article, but there was another article where the wording in the email that Mark Zuckerberg was printed, and effectively what it said, and I'm just paraphrasing here, is that not all of you belong at Facebook and it might be better if you go somewhere else. Now, I would encourage you to read the comment, but that's effectively what it was saying. And I said it when I put out that video that might not necessarily be the best message. You don't want to be sort of like that hawkish on employment. But the real question is, what does this mean for the investment thesis for Alphabet? Because a lot of investors have been buying into Alphabet. Pretty much every value investor on YouTube is very hot on Alphabet. I'm probably the only one who's a little bit somewhat lukewarm because I'm saying that they're hovering around that 50% intrinsic value area, but not under it. And so I've kind of been hesitating a little bit, but I'm a crazy sort of like conservative investor where I really like to buy it at less than 50% of its intrinsic value. And sometimes I miss out on these opportunities. But what does this mean? So you can see here are the results from 2017 to 2021. You can see that they grew pretty much every segment at double digits. YouTube has grown considerably fast. I would say that that's an average growth rate of around 35%. Cloud is also growing at probably an average rate of around 50% or just in the high 40s. But their search has also been growing pretty fast. And so I think in a slowdown, we kind of have to ask the question, and I wrote it up here, is do advertisers refocus their efforts with established platforms, or do they completely pull back ad spend? I think depending on the actions that are taken, this could either be a bull case for Alphabet or a bear case for the digital ad spending industry as a whole. And I think in the immediate sort of term, it'll probably be closer to the overall pullback, but as spending sort of picks up again, I think this could potentially be a bull case for the established players that have proven their value, like Google, like Facebook, and of course a Google platform, YouTube, and Facebook's platform, Instagram. Like, I think those are really key places to advertise. And so when spending does pick back up, which it could at the end of 2023 or early into 2024, that could be a really strong bear case for these companies. And so how am I changing my valuation? You can see that my current opinion is that I really don't know what's going to transpire. And so I have not adjusted my segment growth estimates, but there would be nothing wrong if you actually adjusted your segment growth estimates down, especially maybe in 2023, which is what I suspect that the market's doing. But overall, on average, I still expect YouTube to grow in between that 20 and 30% a year space, obviously coming down every year. I do expect cloud to continue to grow at 25% a year, and I do expect search to grow. Now, search might not grow as fast as I'm modeling, but like I said, the reason why I model it out this way is because then I apply a 50% haircut to the valuation, and then I try to buy under that. So take my valuation for Google with a grain of salt on the revenue side, because I take the cut on the discount that I apply. And so where is the valuation? You can see here that both on an EPS basis and on a free cash flow per share basis, I'm valuing the company at approximately $200 per share. The current share price is just over $100 per share. So this is what I mean about it's kind of close to 50% of its intrinsic value, but not really there. And so I'm still waiting a little bit. Now, I know there's going to be a lot of people who are screaming, yo, just buy it. It's at 60%. What are you waiting for? But I like being greedy, and I've kind of been this way my whole career. And like, I've missed opportunities. Like, here's one that I missed recently. I really like H&R Block, and it actually came down to around 55-56% of its intrinsic value. And then I just said, I'm going to wait a little bit longer because the cash secured puts weren't spitting out a value that I was looking for, or a yield that I wasn't looking for. And now, of course, H&R Block in this environment, people realize that those revenues are pretty stable, and so it's gone to 100% of its intrinsic value. So that was close to a double or 100% return that I sort of missed out on because I get really greedy closer to that 50% of the intrinsic value. So there's certain names that I should be buying. Alphabet should be one where the minute it gets under 60%, I probably should be buying. Microsoft's another one. Meta's another one. But then there's other names that I could probably be a little bit more conservative on. And so that's something that sort of I'm working with. Here's where like value investing turns into a bit of an art and a science. And so it is what it is. Now, if you want access to that Alphabet model and all the other models that we have, I do have a Microsoft model. I have a Facebook model as well, or a Meta model. You can get access to all of those models at the lower tier of the Patreon. And if you want to join us for an epic live presentation where I reserve my very best work for, you can join us on the upper tier of the Patreon. And like I always say, there's never any material obligation for you guys, because if you try it out for the first month and you decide that it's not for you, just let me know before you unsubscribe so that I can refund your first month's subscription, because I don't want you to lose anything if you don't find value in it. And you know what's crazy? Of the 160 or so Patreons that we have now, not a single person has ever reached out to me and said, hey, Tay, I want that refund. So that shows to you the value that's in this Patreon. Now, the other thing that I want to point out to you is that my number one stock, or very close, one or two, is actually crashed recently. And I actually dive into that whole story, which you can get to right here.